What's going on, everyone? So we have a pretty big set of filings to talk about out of the DTC, the FICC, and of course the NSCC. We're going to be talking about the DTC today. It's the same filing basically with all three. So let's go ahead and look at DTC 2021-017. My opinion, the true end game. So a little background on this one. DTC has capital requirements, and their capital requirements for participants have not been updated in over 20 years. Since that time, there have been significant changes to the financial markets that warrant DTC revisiting its capital requirements. For example, the regulatory environment within DTC and its participants operate, or the environment within which it operates, has undergone various changes. The implementation of the Basel III standards, the designation of many banks as systematically important by the Financial Stability Board, as well as the designation of DTC as a systematically important financial market utility, or a SIFMU, by the Financial Stability Oversight Council, have significantly increased the regulatory requirements, including capital requirements, of many financial institutions and CSDs. Similarly, the covered clearing agency standards adopted by the SEC have raised the regulatory standards applicable to CSDs such as DTC. Now that's Central Securities Depositories. That's what CSD stands for. So there have also been significant participant changes over the past 20 years. Numerous mergers, acquisitions, and new market entrants have created a diverse group of participants that has expanded the credit risk profiles that DTC must manage. Moreover, transaction values at DTC have increased significantly over the years. Although the increase does not present more risk to DTC directly, as DTC services are non-guaranteed and fully collateralized, DTC does have an interest in ensuring that its participants have a certain minimum amount of capital to help support the increased activity. So basically what they're doing is, due to all these changes, they're finally increasing capital requirements for a lot of these participants, which is not taken very well by the industry. There's a lot of small and medium players that are pissed off about this because, in essence, what they're trying to do is push out the small guy to allow the big players, basically more control. So in light of these and other developments described below, DTC proposes to enhance its capital requirements for participants as described in more detail below. DTC also proposes to redefine the watch list, which is a list of participants that are deemed by DTC to pose a heightened risk to it and its participants based on credit ratings and other factors. As part of the redefinition of the watch list, DTC proposes to eliminate the separate enhanced surveillance list and implement a new watch list that consists of a relatively smaller group of participants that exhibit heightened credit risk as described in more detail below. So proposed rule changes. This is going to be Rule 1, which is definitions governing law. This is for U.S. banks and trust companies that are banks. DTC proposes to, number 1, change the measure of capital requirements for U.S. banks and trust companies that are banks from equity capital to common equity tier 1 capital, or Set 1 capital. 2, raise the minimum capital requirements for U.S. banks and trust companies that are banks. And 3, require U.S. banks and trust companies that are banks to be well capitalized, as defined in the capital adequacy rules and regulations of the Federal Deposit Insurance Company. DTC proposes to change the measure of capital requirements for U.S. banks and trust companies that are banks from equity capital Set 1, again, and raise the minimum capital requirements for U.S. banks and trust companies that are banks in order to align DTC's capital requirements with banking regulators' changes to regulatory capital requirements over the past several years, which have standardized and harmonized the calculation and measurement of bank capital and leverage throughout the world. Consistent with these changes by banking regulators, DTC believes that the appropriate capital measure for participants that are U.S. banks and trust companies that are banks should be Set 1 capital, and that DTC's capital requirements for participants should be enhanced in light of these increased regulatory capital requirements. Under the proposal, an applicant or participant that is a U.S. bank or a U.S. trust company that is a bank must have and maintain at all times at least $15 million in Set 1 capital and be well capitalized at all times. That is a significant increase from, I believe, $5 million prior, so that's a large increase. Now, let's look at U.S. banks and trust companies that are not banks. DTC does not propose to change the existing capital requirements applicable to an applicant or participant that is a U.S. trust company that is not a bank, although DTC is proposing to make some clarifying and conforming language changes to improve the accessibility and transparency of these capital requirements without substantive effect. DTC treats U.S. trust companies that are banks and non-banks differently because they present different risks based on the attendant risks of their business activities, with trust companies engaging in banking activities being subject to greater risks than trust companies that limit their activities to trust activities. DTC treats U.S. trust companies that are banks and non-banks differently because they present different risks based on the attendant risk. And that's the same thing I just read. Basically, they're treated differently because they have different risk factors. So let's look at proposed changes to U.S. broker-dealers. DTC proposes to increase the minimum excess net capital requirements for applicants or participants that are U.S. broker-dealers to $1 million. This would double the current excess net capital requirements applicable to participants that are U.S. broker-dealers. As described in more detail below, the proposed minimum excess net capital increase will help ensure DTC's ongoing compliance with regulatory requirements and expectations related to credit risk. As described in more detail below, the proposed minimum excess net capital increase will help ensure DTC's ongoing compliance. I don't know why they like to repeat the same shit over and over again. It's annoying. Okay, so DTC proposes to require U.S. securities exchanges. Basically, they're going to require that an applicant or participant that is a national securities exchange registered under the Exchange Act must have and maintain at all times at least $100 million in equity capital. DTC proposes to create a standard capital requirement for participants that are national securities exchanges due to the systematic risk and importance of these participants and the need to hold these participants to a consistent, high standard to ensure that they have sufficient capital to fulfill their systematically important role. Now let's look at U.S. settling banks. DTC proposes to require that a settling bank or applicant to be a settling bank, in accordance with such entities' regulatory and/or statutory requirements, calculates a Tier 1 RBC ratio must have a Tier 1 RBC ratio at all times equal to or greater than the Tier 1 RBC ratio that would be required for such settling bank or applicant to be well capitalized. And a Tier 1 RBC ratio is defined as the ratio of an entity's Tier 1 capital to its total risk-weighted assets, calculated in accordance with such entity's regulatory and/or statutory requirements. So any other U.S. entities that are not otherwise addressed above, such applicant or participant must maintain compliance with its regulator's minimum financial requirements. DTC may, based on information provided by or concerning an applicant or participant, also assign minimum financial requirements to such applicant or participant based on how closely it resembles another participant type and its risk profile. At the end of Section 1 of the policy statement, DTC proposes to make explicit that, notwithstanding anything to the contrary in such section, an applicant or participant must maintain compliance with its regulator's minimum financial requirements at all times. So for non-U.S. broker-dealers, DTC proposes to impose a minimum capital requirement of $25 million in total equity capital for applicants or participants that are non-U.S. broker-dealers. For non-U.S. CSDs, they propose to require that an applicant for a non-U.S. CSD have and maintain at all times at least $5 million in equity capital. DTC proposes that any non-U.S. entity clearing corporation would be deemed to be a CSD for the purposes of determining such applicant or participant's minimum financial requirements. DTC proposes to create a standard capital requirement for participants that are non-U.S. CSDs due to the systematic importance of these participants and the need to hold these participants into a consistent, high standard to ensure that they have sufficient capital to fulfill their systematically important role. Non-U.S. securities exchanges. DTC proposes to create a standard capital requirement for these participants as well, and they must maintain at least $100 million in equity capital. Other non-U.S. entities. For anything else not listed above, number 1, such applicant or participant must maintain compliance with its home country regulator's minimum financial requirements at all times. And 2, DTC may, based on information provided to or provided by or concerning an applicant or participant, also assign minimum financial requirements to such applicant or participant based on how closely it resembles another participant type and its risk profile. Any such assigned minimum financial requirements would be promptly communicated to and discussed with the applicant or participant. And that's basically it for the changes. These are huge changes. So again, a lot of people on this one are very pissed off, especially the smaller players. Next, we'll look at the watch list and the Set 1 requirements. Take a look at that, but big changes. They're preparing for something, so let's see what happens.